The main macroeconomic feature of the week will be the latest non-farm payrolls or jobs data from America, which will be released on Thursday the 2nd of July. That's a day earlier than normal, owing to the Independence Day holiday weekend. This figure caused a massive stir in early June when the US Bureau for Labour Statistics, or BLS, revealed that America had created 2.5 million jobs in May, just a month after 20.5 million Americans lost their posts. This meant that the official US unemployment rate came down to 13.3%. Why was that number so shocking? 3 reasons. First, economists had been looking for another 7.7 million job losses and a jump in the jobless rate to nearly 20%. The addition of 2.5 million jobs, while that suggested the US economy was bouncing back from the COVID-19 outbreak much more strong than expected, raising hopes for a V-shaped recovery. Second, the original estimates for March and April were actually revised down by a further 642,000, so the historic numbers had been even worse than thought. And finally, the BLS admitted it had made errors in compiling the data and then had not corrected them. This was because the BLS survey interviewers were told to classify workers on furlough or absent from work owing to the outbreak for temporary reasons as unemployed. But it turns out that not everybody in that situation was, with some still registered as employed. That caused a real stir, not least because of accusations the BLS was intentionally understating the jobless rate by 3 percentage points to make the US economy look better than it really was. Now, in an era of alternative facts, you'll have to form your own opinions there, but whether you take the numbers at face value or not, one is undeniable. Pretty much all of the jobs gains made by America following the great financial crisis have been wiped out this year. If the US does keep adding jobs and showing greater signs of resilience than expected, the US Federal Reserve could in theory start to ease off on quantitative easing and reassess interest rate policy. How the markets would respond to that is hard to divine, as share prices are currently riding the tide of Fed-provided liquidity, so they might not like the idea of that cheap funding being taken away. Equally, they could still latch on to the better economic momentum and keep going anywhere. Now, on the company front, we're due to get a fairly select number of results statements or trading updates here in the UK, but the week should be no less informative for that. Do again bear in mind the Financial Conduct Authority is still giving firms extra time in which to prepare their figures, so these dates are still a bit provisional. On Tuesday the 30th, we will get results from contractor Costain, online travel agent On the Beach, and cybersecurity expert GB Group. Then on the 1st of July, retailer Topps Tiles will update its shareholders. Then come Primark owner Associated British Foods and packaging play DS Smith on the 2nd of July, before pubster hotel group Fuller Smith & Turner and real estate agent Purple Bricks round off the week on Friday the 3rd of July. However, for me, the stock most capable of causing a real fuss in the week ahead is Sainsbury. The grocer is due to release a first quarter trading update on Wednesday the 1st of July. This will be Simon Roberts' first trading update as Sainsbury's chief executive after Mike Coop's retirement on the 1st of June after nearly 6 years in the job. The shares are up a little over the past year, and this may be because Sainsbury's has done his bit to keep the nation fed and watered during the pandemic and lockdown. The grocery giant gave some indication of trading patterns in the new financial year, which began just before the imposition of the lockdown, alongside its full year results on the 30th of April. The company revealed that total sales, excluding fuel, had increased 8% year on year in the 7 weeks to the 25th of April. Grocery sales were up 12%, general merchandise sales through Argos were up 9%. But on the downside, general merchandising sales in Sainsbury's supermarkets were down 22%, clothing sales down 53%, and fuel sales down 52%. Sainsbury's gave little by way of guidance for fiscal 2020-21 alongside April's full year results. The final dividend, remember, was cancelled to take the annual total down to 3.3p from 11p the year before. However, it did give its core assumptions, and it'd be worth checking those out when you look at the first quarter trading statement. They were high single-digit percentage grocery sales throughout the lockdown, with low single-digit percentage sales growth from late April onwards, thanks to more meals being taken at home, and then, hopefully, normal conditions in the second half. Low teens percentage drops at Argos thanks to lockdown and store closures, and then subdued consumer spending thereafter. Significant double-digit percentage drops from general merchandise at Sainsbury's stores in lockdown and the first half, and then hopefully improving to mid-single-digit declines in the second. Significant sales declines in clothing, albeit moderating to low double-digit drops in the second half, and significant declines in fuel sales before a return to quote normal in the second half. Besides total sales growth, Sainsbury's will also publish like-for-like sales growth numbers at group level. In the fourth quarter, like-for-like sales grew again at a rate of 1.3% year-on-year, and did that including and excluding fuel. Intriguingly, overall earnings estimates for Sainsbury's financial year to March 2021 have sagged even during the pandemic to reflect material increases in costs, notably staff and logistics, increased discounting to shift excess clothing stock, and also delays to ongoing productivity programmes. The company has not taken up government support in the form of the furlough schemes or delayed VAT payments, although Sainsbury's has accepted around £450 million in business rates relief for the year. Consensus is currently looking for around £579 million in pre-tax income, down very marginally on an underlying basis from £586 million last year, though hopes of a year-on-year increase seem to have disappeared for now. I hope that you and your families are all in good health and good spirits during these difficult times. Thank you for listening, and I look forward to talking to you again next week.